EasyEquities is an innovative investment platform. It's the first time the power is given to you, the general population. Now, as the power to invest lies in your hands, we need to educate ourselves and then we can start actually investing. The idea, look, I know you're not following what I'm saying anyway, right? That's okay, it doesn't matter. The real question is, what's stopping you? You have just gone ahead and created your EasyEquities account. You log in and head over to the Invest Now page. You see you have many options: equities, ETFs, ETNs, cryptos, and you scroll through the pages upon pages of options available. And what happens? You start to get scared. You start to fear that you don't know what to invest in. You panic. You remember the words of your overly cautious parents warning you of the risks of investing. You recall your one friend Thando having lost a small fortune while trying to invest, and you start to doubt yourself and question whether investing is actually for you. Hello and welcome. In this video, we are going to discuss the process you should follow in order to decide what you should invest in. The goal of this video is to give you the framework, the basic fundamentals necessary to help you make the right investment decisions so that you can grow your portfolio. So, let's get started. Oh yes, and if you haven't gone ahead and created your EasyEquities account, please go ahead and watch this video. I will show you how to do it there. So, out the gates, let us quickly clarify what investing is. You see, investing is a process of buying shares in a company after a thorough analysis of the business, with the intention of holding those shares for a considerable amount of time. Investing is not the same as trading. Trading is a process of buying shares in a company after thorough analysis, but the intention when it comes to holding the shares is one for a short period of time, like a few minutes, hours, or even days. You then have speculating, which is the process of buying shares in the hope that the share price will go up, and that is in the hope. No fundamental analysis, no research, just hope and a spine-tingling feeling. This video is all about the former, investing, and that is what I'm well versed in my opinion. So, how to invest. When you log into EasyEquities, you'll see you have the following options. You can either invest in equities, ETFs, ETNs, cryptos, unit trusts, baskets, or bundles. What a mouthful. Equities are what you're probably familiar with, which are shares, pieces of businesses. ETFs, or exchange traded funds, are a collection of different equities or shares packaged into a single share. So an ETF can have many different company shares all packed together into one instrument. ETNs, or exchange traded notes, are unsecured debt instruments issued by banks. Now, similar to ETFs, they too can track a bundle of shares, but an important distinguishment is that an ETN, when you invest into it, that money doesn't go into multiple shares like it does when you buy an ETF. Instead, that money just goes straight to the bank. The bank is then obliged to pay you the amount reflected in the underlying index's performance that ETN is tracking. Just a slightly different method in the way the ETN is calibrated compared to an ETF. Now, unit trusts are similar to ETFs in that they hold a group of shares, but they are just structured and taxed differently. But in terms of what they do, their function is the exact same as an ETF, which is the investment into a group of companies. When you invest in a unit trust, that unit trust invests into multiple companies on your behalf. The only difference is that the unit trust structure and an ETF structure, they just work slightly differently. Then we have crypto, which allows you to invest in EC10, which is essentially a weighting of the largest cryptocurrencies in the world. More on that in this video. EasyEquities then has things called baskets and bundles. These are pre-constructed portfolios, which an individual has arranged on your behalf. When you buy a basket of shares, you are buying multiple different shares at once, which you can then change at a later stage. It's essentially just buying multiple shares for you at once. A bundle also includes multiple different shares, but the shares invested in are managed and controlled by the creator of the bundle. So when you buy a bundle, you are essentially putting your trust into some other investor's hands. So you can't alter the construction of the bundle once you've bought the bundle and the shares within it. Only the creator of that bundle can. Now we will cover the investment process for equities, the holy grail of investing, in my opinion. So First off, you see that EasyEquities has a wide variety of instruments. It can take a significant amount of time to skim through all of these, but I have a better option. If you've been following me for a long time, you'll probably know what I'm about to say. One that saves much more time, and that is for you to search for the companies you already know, the ones you are familiar with. The reason being is that because of this, you absolutely need to understand the companies you are investing in. I'm not saying that you mustn't search through all the stocks, you can do this, but then your research of the company will require more time and effort in order to truly understand the business and its competitors and what makes the business tick. Whereas if you already know the company, you are familiar with their products and their services, this provides you with an edge already over all the other Wall Street and JSE investors. This is not my words, but the words of Peter Lynch, a rather famous American investor who has had one of the best track records Wall Street has ever seen. So, as this is for beginners, I will assume at this point of the video that you have identified a company which you already know the business and its main competitors. Right now, we can go ahead and invest, right? Absolutely not. Remember what I said earlier. Investing is the process of buying shares in a company after thorough analysis of the business. Just because you are familiar with the products and services does not mean you have done a thorough analysis. So, what is a thorough analysis? In business school, you learn in finance that a company needs to be evaluated both on a quantitative and qualitative level. A quantitative level will involve an analysis of the financials, the income statement, the balance sheet, etc. The qualitative level will involve a look at the actual business and the products and services that they provide. Starting with the quantitative, the income statement, the balance sheet, the statement of changes in equities, etc. These are all crucial pieces of information which require an accounting foundation. Briefly, an income statement shows you what a company is earning every year. The balance sheet is a snapshot of the assets which the business owns and the liabilities which it still has to pay. These statements are used by an investor in order to value the company. Yes, this idea of valuation. You see, when you buy a share, I'm sure you have noticed that different companies have different share prices. This is because different companies have different values. Some are worth more than others. You may be able to buy a restaurant for 100,000 Rand, but it is unlikely that Jeff Bezos would sell you Amazon for the same price. The simplest indicator of the value of a company is something called market capitalization. When you search on Google for a company's share price, you will see the market cap underneath the main graph. The market cap is simply the price per share multiplied by the number of outstanding shares. The outstanding shares are essentially the shares which the company has issued to the public. So the total value of the company is essentially the price per share multiplied by the number of shares that are available and in circulation. Bam. Now, when we try to value a company, we need to use the income statement and balance sheet in order to provide us with an idea of the company's value, of the company's worth. If we decide that the company is worth more than the stated market capitalization, then we say that the company is undervalued, in which case you would want to buy the share, right? If something is worth more than the price it's currently actually going for, that's a bargain, right? If our analysis, on the other hand, indicated that the company is worth less than the market cap, we would not want to buy the share. Now, how do we determine this value? That is a very complex question, and there are many ways to value companies. Here I will list a few of the most common methods. You have a discounted cash flow method, you have a multiples valuation method, and you have an asset-based valuation method. These are all complex models and valuation methods which require further input and learning on your behalf. However, the output of all of these methods and models is, as we previously discussed, a value, a certain number, which you can then compare to the market capitalization. Once you've done this, you can then go ahead and make your decision as whether or not you want to invest in the company. Now, onto the qualitative. What is this qualitative analysis that I keep on talking about? Which is really where the juice lies, in my opinion. This is where you need to essentially go ahead and understand the business and its unique selling point, its USP. And does it essentially even have one? The easiest example I can use is Apple, as I think it is a company everyone is at least familiar with. What gives Apple its competitive edge, you may ask? Well, it doesn't take a genius to see this, but quite simply, they make truly beautiful products that are visually stunning, a step above the competition, in my opinion. And this combined with their unique software system, the iOS system, which compared to Android, at least initially, was a breath of fresh air due to its ease of use and user friendliness. Still to this day, that is the hallmark and defining USP of Apple. Now, a true thorough analysis is not that simple when it comes to a true qualitative analysis. You see, that is a high level one. A true thorough analysis involves an analysis of a company and its main products, as well as the competitors and their products. This can take a substantial amount of time and effort in order to truly understand where a company fits in. But this is the most important part of your research, in my opinion. You see, it is important to identify that a company does have a USP compared to all the other companies you are investing in, because that unique selling point, that competitive advantage, is what will carry the company and its business into the future. So it's very important to identify that a company does have a USP, because if they have a USP, they will continue to grow. It's as simple as that. Now, I would just like to add in here that a competitive advantage can take many forms. It could be better technology, better marketing, a quicker service, or a cheaper product. These are the main unique selling points which can differentiate a business, in my opinion. Now, this qualitative understanding can be obtained by doing the following. First of all, you want to start with an overall look at the industry that the business is operating in. What are the industry's prospects? Where is the industry heading? What are the main factors which drive the industry? Once we have an understanding of the industry, we want to go ahead and look at the country which your potential investment is operating in. What is happening in that country? Do they have a solid financial system? Are they on the brink of war, etc.? These are necessary considerations because those type of macro factors can greatly affect the business and its future prospects. Once you have done this, we then want to go ahead and look at the company and its competitors. What products and services are they selling and how do they differ? So we've essentially covered now the quantitative and qualitative analysis that one wants to go ahead and do when they are considering investing in a share. But now, as far as an actual process is concerned, when you are skimming through shares on EasyEquities and you've identified a share that you know the business of, this is what I recommend you go ahead and do. The first thing you want to go ahead and do is perform your qualitative analysis. Get an understanding of the business and make sure it has its unique selling point. Once you've gone ahead and done that bit, go ahead and move on to the quantitative part. This is where you will, as you mentioned, zoom into the company and its financials in order to make your valuation assessment. Once you have done this, you can then go ahead and decide whether or not you want to invest. Now, as you know, there are many different types of instruments that you can invest in EasyEquities. I'm very briefly going to go over the ones that I am familiar with and the pros and cons of each. So, what is the attraction to equities over ETFs, ETNs, and unit trusts on the EasyEquities platform? You see, the possibility of high returns, that is the attraction. When you are investing in a share over an ETF is much more diversified than a single share and is therefore not as volatile. A single share, on the other hand, is much more volatile. Its share price has much wider movements. But with that increased risk comes the possibility of higher returns, of higher rewards. Now, when it comes to ETFs, unit trusts, and ETNs, on the other hand, and also baskets and bundles, because those are essentially groups of companies, they are all quite similar, right? Because it's a collection of shares which you are investing in. So, because you're investing in a collection of shares, they are not as volatile as a single share. So, if your risk profile is someone who's not looking for something that's going to bring a lot of volatility, then an ETF, a unit trust, or baskets and bundles would be more your type of investment. So it depends on your risk profile. Now, when it comes to investing into ETFs, unit trusts, baskets and bundles, they are all quite similar because they are a collection of different companies and their shares. So a thorough analysis of an ETF of a unit trust or baskets and bundles and the shares they invest in is important. Realistically, I would look at the largest holdings which make up the instrument in order to decide whether or not I want to invest into a ETF, ETN, unit trust, basket or bundle. What is the attraction, you may ask, for these type of investments? Well, it is incredibly hard to outperform them in the long term. Don't take my word for it. Warren Buffett has gone on record multiple times saying that if he knew nothing about investing at all, or he didn't have the time for it, he would quite simply invest in an already diversified instrument such as an ETF or unit trust. Watch my video on the top ETFs for some of the most popular and best performing ETFs in the world. Now, the other one I just want to touch on is cryptocurrency. You see, we have crypto, which, to be quite frank, is something I know nothing about. Mark Cuban, a famous American self-made billionaire, has the right idea when it comes to crypto, in my opinion, which is to put some money into crypto with the expectation that if you lose it, it doesn't hurt you. So that concludes this video. I hope this video provided a decent foundation for you, the beginner investor. I would love to hear your thoughts on investing and what it has been like below. And I would appreciate any recommendations for future videos. I will see you all in the next one.